The first element of accounting are assets. So they're the ones that are going to go on our balance sheet. We haven't really done what these reports are, but don't worry, we will. But the balance sheet has assets, liabilities, and owner's equity. And we're going to start with assets. So we need to know a real fancy definition. We could just say assets are the things that the business owns. And that would be true. Assets are what the business owns. But what we need for our course is this definition here. So whenever we get asked, we're going to say an asset is, it's got three parts. The first part is a present economic resource or benefit. The second part is it's got to be controlled by the entity or the business. And the third part is it's got to have arisen as a result of a past event. So what we want to do is we want to know this definition, but we want to be able to explain what it means because these words are a bit clunky and a bit formal. So what do they mean? Well, let's take the first one. What is a present economic resource or benefit? It just means that the item's got to be able to provide the business with some sort of economic benefit in the future, e.g. cash, or you can use it, etc. Controlled by the entity, what does that mean? It means it's the business that can determine how and when the item is used, and only the business has the right to access its benefits. No other entity can decide how the asset is used or controlled. And lastly, it's got to have arisen as a past event. What does that mean? It means it's got to have been acquired by the business as a result of a transaction in the past. And that necessitates that there will be a source document to back up that this happened. Let's just take a look at these things and say, well, what are the common ones that we're going to come across? In the real world, there's heaps of assets businesses could have, but the main ones we're going to see are cash. Now, when we say cash, there's going to be a few different types. It's going to be the cash in the bank accounts, the cash in any cash registers, in locked safes, etc. But yeah, we're just going to call it cash. Or we might use the word bank. Either's fine. Cash or bank. Cash at bank, same thing. Inventory is going to be a big one. That's just stock, but we're going to use the word inventory. And inventory, when we say stock, it's items that are bought with the sole intention of reselling to customers at a profit. We're going to deal with that in much more detail much later on. But for now, just think inventory. Inventory is the stock that we sell. Accounts receivable, that is amounts owing from customers who purchased from the business on credit and didn't pay on the day of the purchase. They will repay in the future. You might also see the word debtors to describe this. We're going to use the term accounts receivable, but debtors is also means the same thing, and it's used quite commonly in the real world as well. But yeah, it's a customer that owes us money for goods or services we provided, and they haven't paid for yet. We gave them credit. Vehicles, that's a common one. So the vehicles that we have for employees to drive as part of their jobs, to make deliveries to customers, transport items, etc. IT equipment's a common one, computers, laptops, phones, printers, etc. And you're going to see this one, fixtures and fittings. It's a bit weird what's a fixture and a fitting, but it's basically the shelving and display equipment used in a retail store to present the inventory of the business. So they're probably the most common ones, along with premises, any properties we own. But that could be anything that the business owns. Let's just look at the parts of this definition before we move on to liabilities and say, well, what does this mean? A present economic resource. It's got to be able to provide us with some sort of economic benefit in the future. And that's the first key part. In the future, the business has not yet received or consumed the economic benefit of that item. It will be consumed or received in the future. So whatever asset we acquire here on today, we haven't got the benefit from it yet. It could be we're going to get the benefit within the next year. And that's called a current asset, and which we'll deal with current and non-current assets later, so you don't need to remember this now. It's just to sort of give you a heads up. We might get we might decide to use that asset in plus 1 years, or 2 years, or 3 years, or 4 years. That's okay too. We would call that a non-current asset. But the point is, the economic benefit has not yet been consumed. It will be consumed or used in the future. What else do we need to know? Well, part of this economic benefit, what does that even mean? Does that mean it's money? It could be money. So we said here, the economic benefit you get could be money, but it could also be usage. It doesn't have to be cash. What we want to ask ourselves with every asset is what resource or benefit will we get? So let's take an obvious one, cash. Here's cash and here's, we got it today. What can we do with it in the future? What's the economic benefit? Well, we're going to be able to spend it. And we could spend it there, whenever we decide, because we control it. But that's an obvious economic benefit. What about for what we call an account receivable? You signed a client up, you charged them, but they haven't paid. Perfectly legitimate business technique. There's nothing wrong with that. But they are an asset. What is the economic benefit the business is going to get from that customer in the future? Well, it's going to be, we're going to receive cash. So that's kind of the same economic benefit as cash. We're going to get, except for with cash we could spend it. The benefit is we're going to be able to receive the money and spend it. What about with a vehicle? A vehicle eventually will sell it one day and maybe get some money, but the economic benefit from a vehicle is not cash. It's this one. It's usage. We can drive the vehicle in the future. So the economic benefit there is being able to drive it. What about with a laptop? For an item to be an asset, it's got to have an economic benefit. How would you describe the benefit from a laptop? Well, you could just say we can use it. Most assets, that's what you're going to say. It's just an asset or an item that we can use, and that's the economic benefit we're going to get. What about this second part? It's got to be controlled by the entity. Only the business can decide how the item is used and has the right to access its benefits. So it's got to be under our control. Let's just take an example to demonstrate this. Jack owns a small business. His brother has lent him the use of the delivery van to use in the business, and it's valued at $50,000. Is this an asset of Jack's business? And we're going to say no, because he does not have any control. Even though he's the one using the vehicle at the moment, he can't decide how it is used. He can't decide things like this. He can't decide to sell the van, put new tires on it, paint the van, whoops, etc. Just to go back. Yeah, it's another entity that can decide that, Jack's brother. So this is really important. An asset is not an asset unless the business is the one that controls how and when it is used. And lastly, it's got to be a result of a past event. It's got to be required in some sort of transaction. And that's good because it necessitates that we will have a source document to verify the acquisition of the asset. So if we take our business and we take this car, we went to the car dealership, they had the car, we had money, we did a trade, and there's your past event. Now we'll have a source document to prove that, and we got ourselves an asset because it's got to have come as a result of a past event.